Hello Archers. For my next video I want to break down the 4 different types of permanent life insurance. Check out my website at AFC0007. So I'm going to draw this red line across the top here. This is going to represent our level of risk. Our risk being the lowest on the left and the highest on the right. The risk being that the way that your cash value is paid and how you make money on them, it's going to depend on your level of risk in each one of these. Your lowest level of risk is going to be your whole life, and then what they call universal life. And then index universal life. And then variable universal life. So whole life, the reason that it has the lowest level of risk is because it gets paid in dividends. The insurance company is going to pay you a percentage of their profits annually based on the amount of money in your cash value. Universal life is going to be paying you interest on your cash value based on the Fed interest rate, and this is paid monthly. So the money in your cash value at the end of the month, they'll pay you in a percentage of that cash value based on the Fed interest rate. Now, as we go right along this line, the reason that the index and variable universal life is higher risk is because your money is put into the stock market. And an index universal life puts it in index funds, and there is a fixed account that is also associated with to diversify your money. And then there in the variable universal life, it's in mutual funds. And there's also a fixed account that you can diversify your account with. Now, with the cash value, if you want to take money out of your cash value, whole life has liquidity with it. Okay, there's usually no fees. You can take money out of your cash value if you need to. Universal life, for the most part, depending on the insurance company, there's usually no fees as well, so you have liquidity with your universal life cash value. Index and variable universal life, on the other hand, have high fees, especially in the first few years, for the first 10 years usually. The reason being is that these type of products are built for growth, and you want to maximize the amount of money that you're growing in the stock market over a long period of time. So these have very high fees associated with withdrawing your money. The preferred way for life insurance for you to take advantage of the cash value and withdrawing money is to do it through loans. This is a great benefit of permanent life insurance, is that you can take loans out against them. Usually the loans are based on about 80% of the cash value, but it really depends on the insurance company. They usually have an interest rate that they'll charge you on the loan. This is usually compounded annually, but it just really depends on the insurance company. Whole life is when it comes to premium payments, is the simplest. You're going to have your annual payment or your annual premium, and you're going to have your target premium, if you choose to use it. Now, Universal Life is a very unique product because it is mainly designed to be more of a life insurance product and less of a cash value product. The reason being is that these products are usually geared to people who are about 50 years or older. So the premium payments are going to pay for more of your life insurance and less in the cash value. So if you're not really concerned about cash value and you're more concerned about life insurance, Universal Life may be a better product for you. Index Universal Life, I think, is one of the most misunderstood type products out there. They're going to offer downside protection with your index funds with what's called a floor rate. This is downside protection from the stock market loss. But they're also going to have what's called a cap rate on your gains. The reason is the insurance company is going to insure your losses by stopping them at a certain point with the floor rate, but they're also going to limit your gains by taking the profits at a certain percentage. And I will break down Index Universal Life in more detail, but this is just a very simple way of saying that this is how you make money inside an Index Universal Life. Now, Variable Universal Life is going to ride the stock market. It's going to take advantage of the highs and lows of the stock market. With Index and Variable Universal Life, this is taking advantage of the highs and lows of the stock market is done through dollar cost averaging. And I'll break down a video with dollar cost averaging here shortly. So with your Universal Life products, unlike your whole life products, which are very simple when it comes to premium payments, the Universal Life products, Index and Variable, are probably the most misunderstood products out there, just based on the fact that your cash value is sitting in a bucket, and we went over this in a previous video that I did. And your premium payment is going into your cash value bucket, but what's coming out each month is a cost of insurance and different fees that is dripping out of this cash value. With Index and Variable Universal Life, it is highly suggested that you take advantage of the target premium, which I covered annual and target premiums in the previous video I did before this. The reason being is that you want to overfund the Index and Variable Universal Life because of the cost of insurance and the fees. So when the stock market's down, you're not making any gains, your cash value isn't making any gains, and you're going to lose money in these type of products if you don't overfund them using your target premium. Sometimes insurance companies will say that these have a flexible premium, meaning that you can change the amount of money being put into these type of life insurance policies, but that's really just taking advantage of your target premium, okay? And that's the payment, the additional payment that you make over the annual premium. I want to break down each one of these products individually in separate videos, but there's a lot of information here and this looks very busy and very complex, but if you're looking to shop for life insurance, especially permanent life insurance, what level of risk are you willing to take to make money in your cash value, and what are you comfortable with?